let's look at the media business. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. We will look at one of these sectors, the communication sector, and specifically media. First off, let's get the bigger picture here of the market, because it is pretty darn wild. If you look at the megatrends, we are seeing this extreme performance, and the multiple here of the themes here are seeing 4-digit gains. The thing is that I think it is pretty clear that we have a bubble. There's bubbles across many markets at this point. The key thing about the bubble is that it is fun for the bulls when it goes up, but it's very important to be able to have a balanced portfolio, some bullish and some bearish positions. Because some of the most disastrous losses that happen in the market, that is when you get caught being only on one side of the fence, like if you are purely bullish and then we get a major pullback. Or the inverse. So here's the media ETF. We see here 169% gain from the low. We are at all-time highs at the moment, and the market is going to open up pretty bullishly today. This is the seasonality, and we don't really have any strong seasonality until April, but that is only 67% of the time. I would argue that maybe only December is the month, the time when we have some very strong seasonality, because 73% of the time it closes higher than it opened. That is something that is tradable. You can actually make a decision based on that seasonality. 67 it is leaning bullish for sure. 47% is leaning a bit bearish, but it is not that strong. So here is all the data we have here, weekly data points. This is the chart, of course. And quite clearly, the bulls are in control. But if we compare this rally with the previous rallies, we can quite obviously see a major difference. This security used to move in, what we call the, cycle patterns. You see that there is this general rhythm to this security, moves in these waves. Now we have seen, a parabolic rise. We have never had this high of an RSI. The PPO is, blown through all prior levels. The accumulation distribution is, somewhat corroborating this rally, but we would ideally want to see it higher. 8% strong correlation here with the S&P 500. If you look at the daily data points, okay, throughout the entire history of this ETF, the RSI has never been this high. You see here quite clearly, when the RSI previously has reached these kinds of levels, it hasn't worked out. Pullback, pullback, pullback. That's interesting. So literally, like 100% of the time, it hasn't worked out to be at these levels. PPO is now beyond anything we've ever seen before, and as far as indicators of excess, the facts are pretty clear. Looking at accumulation distribution, we do actually see some weakness in the sense that on the daily data points, we do not have a full corroboration of this rally. So that is interesting. There is some bearish divergence, which suggests that this rally has been on lighter volume. I strongly doubt that this latest move has been due to major institutions pouring money into this ETF in particular. Mutual fund managers and other big players, they will be very careful with these kinds of moves. Okay, so let's explore a bit further, but I think you can quite clearly see yourself. The bulls are definitively in control, there's no doubt about that. But there's also risks at these levels. Looking here at Finviz, they don't have that much data here. we see that there are no options available. That is unfortunate. It is shortable though for, the bears. Looking here at the valuations and dividend, you can see that the dividend here for the S&P 500 is 1.46%, while the dividend here for the media ETF is only 0.25%. So as far as the dividend goes, not really that impressive. When we look here at the calculator, here I calculated the price to earnings difference, and you can see that the PE for the S&P 500 is, around 6% below the current, the current level for, the media ETF, which is, quite meaningful. And here is actually a very interesting calculator that I have made, where you can really explore the power of buying low and selling high, because for a lot of people it's a bit abstract. They hear buy low, sell high, and they don't really know what it means. So let's now do some basic math. So let's say that you have a stock that is at $100. Well, let's say ETF. And let's say that it falls down to $50. So that is a 50% loss. But here is when, the power of buying low and selling high starts to become more obvious. Because in order to recoup that loss, from the low, it needs to rally 100%. Let's say that it falls to $25. Now it needs to rally 300%. And, when you get really, really low, it starts to become quite spectacular. So let's say that you have, a stock that went from $100 and down to $4, a minus 96% loss. So this could be like some company maybe heading for bankruptcy, or maybe an ETF that's gone through some extremely bad times. If you were able to get down and buy that low, and let's say that it was to go back and break even, that is a 2,400% rally. And even when we talk about, smaller numbers like this, you see a minus 10% loss from the low, it needs to rally 11.11% to break even. Hence, buying low and selling high generates a lot of alpha. Okay, so that's just some basic math, but it is super important. Okay, let's look a bit at, maybe the fund flows here. We don't really have that much data. It's, you see that there certainly has been a lot more interest before. Looking at the holdings, Twitter is a very big component. Spotify, you see that there's a lot of mix of new and, old school media. Frankly, there's quite a tilting towards, more social media stocks, basically like the modern kind of media companies, but also some legacy. So let's look a bit further, breakdown. So you got some tech and consumer services. Actually, a bit more is classified as tech. Market cap breakdown, 100% small. Yeah, I think there are some issues here because this doesn't make sense, because Google is definitively not a small cap company, nor Disney, so yeah, there are some issues here. So let's take this with a grain of salt. Anyway, okay, so let's sum up my take here on this ETF. This is a bit of a frustrating market because, I'm a huge fan of long, short portfolios, to be market neutral. We have, this gargantuan bubbles all over the place. And historically speaking, they have always ended in tears. Bubbles, they pop, and then you have a major crash, and if you are completely in bull mode, bull, stocks will go to the moon, everything will go to the moon, then you will not be able to act appropriately when there is a pullback. And as we saw with the percentage calculator, it takes a lot to get back to even. That's just how the percentages work. And that is how there's enormous alpha that can be generated by buying low and selling high, and, in a broader sense, to have a market neutral portfolio in which you can frankly minimize losses as much as possible. In the bubble, there is a temptation to be 100% bullish, but, historically that hasn't worked out.